Today, we are going to talk about whole life insurance in a down market. When I say a down market, I'm specifically referring to the economy, and if there is a recession, we'll talk about why people put money into whole life insurance for the cash value during a recession, and then also how they use it in today's video. Toward the end of the video, we're going to look at a specific case study of an individual moving cash into a policy, and then we'll demonstrate how we can use it through policy loans. It'll really mimic what we've seen a lot of people do over the years. What I'll start with is I got into the business in 2011. Which is a few years or several years after 2008, which was a major recession. A lot of people remember that time. And in 2011, what happened in 2008 was still fresh on everyone's mind. People were very conservative. They were waiting for the economy to recover. There was still a lot of uncertainty going on. And I remember in 2012, I was at a mini conference / training, and there were these two annuity wholesalers. A wholesaler is someone talking about annuities and trying to get all of the licensed professionals to sell the product that they represent. But what stuck with me, and I remember distinctly to this day, is one of the annuity wholesalers. Remember, he's pitching annuities. He had owned whole life insurance, and he said, my whole life insurance policy in 2008, I got my dividend of 7% plus, and the cash value just kept on going up. Like, I love putting money there. I can't say anything bad about it. And this was someone who was pushing a different product and service that they wanted us to offer. And it just stuck with me, the way he said it and the fact that it added some credibility to whole life insurance. When I was very early on in my career, I was still learning a lot about it, and it stuck with me to this day. And since then, I've spoken with several individuals, more than I can count, that have owned whole life insurance through recessions. I majored in history in college, and when you look at the history of whole life insurance, they didn't teach me this in college, but my background majoring in history and then looking at the history of whole life insurance, you can see how it's done over the years throughout recessions. It's always been a very stable asset, and people are attracted to it because of that. Now, it has to be set up right to get rid of the piece that everyone hates, which is taking forever to see any real buildup in the cash value, and I'll show you how to overcome that today. But I hope that story made sense, and I promise it'll lead right into why people use whole life insurance and also how they use it, and we will be, as always, laser focused on the cash value. Let's have some fun. So, why do people use it? The three core benefits of the cash value are as follows. Bullet points when we look at the details of the product itself. Number one, it is a safe place to put money. The cash value in a whole life insurance policy is about as safe as it gets. The money continues to compound over time, regardless if things are very, very uncertain, meaning the economy and market are not doing well, or if things are booming. We see the cash value just continue to appreciate over time. I like to refer to it as a peace of mind product. We'll pull up some dividend history in a little bit. Number two, it's very liquid. It's very easy to access the cash value, especially if I see a downturn in the economy. Let's say the real estate market values drop and I've got access to cash value where I can take advantage of the opportunity. We're going to look at an example of that, but this is huge for a lot of people. I can access my cash value fast. And then third, the tax benefits. This is huge. If I do everything right, I can access the cash value completely tax-free. So let's start with a quick example of some dividend history. This will be pretty cool. So this is one of the major mutual companies. This is their dividend history for 2024. We see that the dividend interest rate is 5.9%. What I like about this dividend history, however, is that it goes way back in time. This company has actually paid dividends for over 160 years, but is going back to 1959. I hope that's far enough. Anyway, here's what I want to highlight. 2008. What was the dividend? 7.25%. The next year, it actually came up a little bit, but then started to come down. The reason why it came down, what else came down during this time period? What happened to interest rates? What could you get on a CD? What about a mortgage? Interest rates came down. what you'll typically see dividend interest rates move with are interest rates in the economy, in the interest rate environment. So as interest rates have been at historic lows, we'll see the same is true of life insurance companies. Unless we go way back to the 1950s and 60s, aside from that, we have been in a very, very low dividend interest rate environment. Over the past 2 years, we've seen dividends level out and begin to increase as a result. The opposite is true if we look at a very high interest rate time period. Interest rates were very high back in the 80s. The same is true of dividend interest rates. So it is a very safe and stable place to position money. I just see my cash value continue to compound. Most people we work with have money in whole life insurance and also money in other areas. It's very rare that we work with someone that puts everything into a whole life insurance policy. Frankly, unless you own a business and you're putting everything in your business, I don't think that's a good idea. I do like to diversify. It's more fun aside from being safer and smarter too. Anyway, back to the the why. So why do people put money into whole life insurance for the cash value where they can use it in a down economy, a recession? Here's really what we see the most. People who keep money in the bank will typically move it into a whole life insurance policy. And the reason why is because I can use my cash value as a personal line of credit instead of having to A, use my cash, or B, go to a bank for financing. In a down market, is it very easy to go to a bank and get a loan? Is it quick? Not really. There's headaches, there's stress, people worry about the interest rate changing and such. This is very easy. It's fast and easy, which is a big reason people like it. When I look at the loan rates on life insurance policies, a lot of times I can find fixed loan interest rates between 5 and 6%. So if I can find a fixed rate between 5 and 6%, when interest rates are higher than that, well, now I've got a cheap source of financing through my policy. If loan interest rates are low again, let's say we rewind the clock back to 2020 and 2021, what were interest rates at? They were low, 3% or even less. What a lot of people we worked with did back then is take their policies to a bank. They would assign the cash value as collateral to the bank, and they would receive a line of credit against their cash value. The bank would typically give close to the lowest rate possible because the bank viewed it as if they were loaning against cash. So it's a nice option to take advantage of low loan interest rates if interest rates are lower. But if interest rates go up, if I can lean on a fixed loan interest rate with a policy, that's a nice advantage. And if I have a variable rate with a policy, that works too, because you'll find that the variable rate with a policy is not quite as variable as interest rates with a bank, but we've got other videos that go into detail on that. But why people use it is really for the line of credit feature, in addition to the safety. So it's a safe place I can position money, just continues to appreciate over time. If I do everything right, it's tax-free, so that's a huge advantage. But then also, if I've got an opportunity, let's say there's a real estate correction, and that's going to produce me the highest return, or if I'm going to invest in my business, what I can do is access the cash value in my policy, just like a line of credit. Here's why people do that and really how it works. So we're going to look at an example of a 60-year-old, but before I do that, what I want to hit on is this. So when it comes to policy loans, because this line of credit piece is important, if you have a policy with cash value of $100,000, pretend it's earning 5% every year. If you take a loan of $50,000, there's a cost to borrow, so you'll have loan interest that is due in that $50K. You'll have $50,000 of remaining cash value. Think of that as your remaining equity. Here's my question though. Before you took a loan, you had $100,000 in cash value earning 5%. After you take that $50,000 loan, what are you earning the 5% on? Is it just the remaining $50,000? No, it's the full $100,000. So with a life insurance policy, when I take loans against it, I continue to receive dividends and interest, the full compounding on the full balance. Money still in cash value and the outstanding loan. That's a nice feature of the policy. So going back to how people use it as a line of credit, I can build up this big bucket of cash value. I've got to fund it to do that. But now it's going to continue to compound for me, and I can access it while I continue to receive that compounding. We're going to look at an example of that. But what happens is I keep earning interest on my full cash value, even though I've accessed some of my equity. So the example that we will look at is as follows. We've got a 60-year-old individual. He's got about $600,000 sitting in cash, and what he wants to do is move that into a policy over 4 years. At his age, this is one of the most efficient funding periods, meaning if we did it over 3 years, his cash value performance would not be quite as strong as doing so over 4 years. So the reason for the 4 years, it gives him the most cash value. So $600,000 divided by 4 years is a total of $150,000 per year. And again, this is money that's just sitting in cash. It's actually sitting in a trust account. So if the trust owns the policy, which it likely will, this also provides some potential generational wealth if that is part of his plan, which a lot of people are into that because the death benefit on a life insurance policy is paid out 100% income tax free. All right, let's take a look at the example now. What he's moving into the policy is in blue. This is his annual outlay, $150,000 per year for 4 years. Starting at age 60, by year 4, he's 63. That's when he makes the last payment. So with the cash value, what's the drawback? This is something I forgot to hit on, actually. I don't want to brush over this because it's a very important piece. When it comes to a whole life insurance policy, this question comes up quite a bit. What is the drawback? Why would someone not do this? Here it is. The first year is always the worst year. I'm going to have less in cash value than what I pay into the policy. The main reason why is because I've got the insurance premium piece. That's the expense piece associated with the policy. The first year hit is usually going to range somewhere between 10 and 20% of the first year deposit. So if I paid in $100K and had a 10% hit, that'd be $10,000, which means my first year cash value would be $90K. It's a $10,000 loss. That's the drawback. There are some products that minimize that hit a little bit more, but no matter how well we design the policy, the name of the game is minimizing that hit as much as we can. No matter how well it's designed, we'll still have that hit up front. So going back to our spreadsheet, what do we see here? We paid in $150 the first year. We've got about $132,000 in cash value. Your premium is $18,000 and change. The true minimum is $15,000, but we've got a term insurance rider attached as well. Without getting into details, that prevents a MEC, modified endowment contract, which is a taxable event. Point is, we've got the insurance expenses or the premium minimized as much as we can in order to maximize this guy, this PUA rider. PUA stands for paid up additions. I like to call this cash dumping because it's a lot like we're dumping money into cash. Oh yeah. So there's your cash value in the first year, $132,000. You paid in $150. That's the hit up front. That is the number one drawback to whole life insurance. But this model is displaying how this individual is first moving money into the policy to maximize the cash value. Next, we want to look at how he uses it. Before we do that, let's focus on the actual growth here. So we said the first year hit was what? Between 10 and 20%. In this example, it is what? 11.85%. Meaning, if we put a percentage to this, you pay in 150, you've got 132. The loss there is 11.85%, which will come out to just about $18,000 if we want to look at it in terms of dollars. But we see exactly what's going on when we look at it. So now we can see each year what happens. First year, I lost money. Second year, I lost money. What's happening is I'm purchasing that death benefit up front. Yes, we're minimizing the expenses, but the insurance company still has that charge there. So in the first and second year, when I see that loss, that represents the fact that you paid in $150 and you got less than $150 back. So let's look at year 2. Year 1, how much did you have in cash value? $132. How much did you pay in year 2? $150. Your cash value is worth what? $275. If you just take the $132 and add $150, which is how much you paid, how much would you have in cash value? $182,000. How much do you have? $275. That's a loss. The loss is almost $6,700. After that point in time, what happens? Well, now I see I get my $150 back, plus a little bit more. It's compounding now, and it gets better and better each year. What is highlighted in yellow here is the break-even point, which is when you get your money back. So you paid in a total of how much? $600,000. By year 4, you've got $590. Year 5, you pay nothing in. The out-of-pocket is 0, and your cash value is $613,000. The growth that year, $22,523. With no risk. It also has the tax benefits. And then here's the big one. If he decides to access the money, he keeps getting this. So if I want to take policy loans, I keep receiving the same dollar amount in growth. Want to see? All right. So what we have on the left is exactly what we just looked at. You've got the annual outlay, total payments, the break-even point between years 4 and 5, the annual growth rate and percentages. This is exactly what we saw. In red, we're going to look at taking a loan. LTV stands for loan to value, 95% of cash value. That's very close to the maximum loan you'll be able to take. So what this will do is pull from your cash value and take 95% of that figure. So pretend this is you for a moment. You have funded your whole life insurance policy. You moved $600,000 in. A recession hits. The real estate market crashes. You see an opportunity available. In order to take advantage of that real estate opportunity, you need $500,000. You look at your whole life insurance policy and see that the cash value is $590,000. You say, I want to use my cash value to take advantage of this opportunity. So, scroll our eyes to the right. You take a $500,000 loan. When you take that $500,000 loan, what happens to this? The equity, the money that you can access, drops, just like a line of credit. If you have a line of credit, before you take any loans, what do we see here? Year 4, your cash value, $561,000. Okay. We want to take a $500,000 loan. Watch this column here. Comes down to $61,000. So if you had a line of credit with a bank for $560,000 and you tap into $500,000, how much more could you borrow? The additional $60,000. It's the exact same thing right here. So you take that $500,000 loan. The interest rate is based on the interest rate with this product right now. This one is a variable loan rate of just about 5.7%, slightly higher than that. But looking at that, there's the $500K loan. There's your loan balance. This column, the annual interest is the interest you are paying to the insurance company each year. This is my favorite thing to look at. We're going to look at it right now. What am I paying to the insurance company in interest? And what am I receiving from the insurance company in growth? Annual growth represents the dollar amount that the insurance company is giving you. This is a combination of dividends and the guaranteed interest they are applying to your cash value each year. So right here, do you get more or do you pay more? You pay more. You take a loss really when you look at it that year. How about the next year? Gains, 22.5. What you pay, 25.6. Close to a wash. Now, what I'll add about this, we did elect to begin to repay it, and we're applying $50,000 per year at the principal. We can pay it back however we'd like, but we're just going to pay it back over 10 years in this example, $50K per year. But when you chip away at that loan principal, naturally, the interest amount goes down. If we look at the next year, what do we see? Well, now the gains are higher than what you're paying in interest. You're going to continue to receive this compounding on the full cash value, even though you have a loan outstanding. Keeps on moving forward. So now I can see when that loan is paid off, the total gain, it's the total dollar amount I received from the insurance company, and the total amount of interest I paid to the insurance company. Most people are focused on the yearly, but it's nice to see the totals too. And then the death benefit. This is important to hit on because it is a life insurance policy. When you took that $500,000 loan, look at your death benefit pre-loan. $2,050,000. Post-loan, subtract $500,000 from that number. What do you have? $1.55 million. Anytime you take a loan against a life insurance policy, yes, you do continue to receive dividends and interest on your entire cash value. How the insurance company makes it work for them is, number one, they do charge interest on the loan, so that helps offset the fact that they're still applying dividends and interest to your entire cash value. But then number two, they also collateralize the death benefit dollar for dollar. So if you die with a loan outstanding, the insurance company is on the hook for whatever the total death benefit is, minus the outstanding loan. But I hope this made sense. This is meant to demonstrate how someone is specifically using the policy, or how they can specifically use the policy in a down market through the loan feature. If he just wants to put money in there and let it sit and grow, we see what it looks like over time. This is all based on the present dividend interest rate. If the dividend comes up or down, that will impact the annual growth rate of the policy. But that's something we track as time passes, so we can see the real performance of someone's policy. So with all of that said, I do hope that this video helped. I hope you enjoyed it. Let us know your thoughts, and if you have any questions, if you are interested in connecting with us, you can find us at ibcglobalinc.com. All we do is set up whole life insurance policies for maximum cash value and continue to work with everyone who gets a policy with us as long as you have your policy. So if you keep it forever, we work with you forever. As always, I hope this helps. We'll talk to you soon. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.